Last time I was here, I talked about more behavioral finance stuff. So this time I'm going to talk a little bit more about Kruse Asset Management process and some of the differences between who we are and who some other people might be. So we met, sorry, my little mouse is a little, okay, so who we are not. Some people get confused between what an investment advisor is and what a financial planner is. We're investment advisors, and planners are completely different, okay? And not the same. We focus on investment assets in the present. So the philosophy being that whatever you do today, if you do it the most efficiently, all your futures are going to be better off. Okay, I'm not trying to disparage planners because they do a great job in what they do. They focus on planning for cash flow. How do we pay for college? What number do we need to be at retirement? How do we plan for our parents' health issues? Things like that. It's not so much focused on investing your money today. Okay. We also get paid a little bit differently. We charge on assets under management, so we take a small fee of the assets that we're managing. If your assets go up, our fees go up. Assets go down, our fees go down, so our interests are very much aligned. They generally charge a fee for a particular plan that they set in place that the client itself has to implement. So they can't make you save for college, your kid's college, right? They might sell you insurance as part of the plan, but for the most part, the planners tell you what to do and then you have to execute it. As an advisor, I actually execute the plan. Other thing is, we dabble in planning. I need to know that my clients are not going to run out of money, and they dabble in investing. They need to be able to understand the markets as well, but neither one are our strengths or our forte, okay? Other things that we're not brokers, okay? You might say, okay, my broker did this, my broker did that. Brokers are guys at large investment banks like Morgan Stanley, Goldman Sachs, Northern Trust. Again, nothing wrong with brokers, we're just not them. We have a fiduciary responsibility to our clients to actually put their needs first. That seems like a very logical thing to do, but it's not a requirement of a broker. A broker only needs to disclose risk. They can sell anything that they want to anybody they want as long as they disclose the risk. You would think that you should put your needs first, and we believe that. So another disadvantage or another advantage we have, I think, is I can choose from anybody's product, including that broker's product. So a guy at Goldman Sachs or Morgan Stanley might be selling product. Those guys come and pitch me for their product. So I can sell anything. They typically are kind of, I will say, asked to or motivated to sell their own product. And the reason being is the interests are quite differently aligned. So a large bank, a CEO of a large bank, has 10,000 brokers working for them. He can't have 10,000 brokers doing 10,000 different things. It sets him up for a liability. So they rein in the products and motivate their clients to do, or their brokers to do a particular thing so that they can manage the risk of the firm. It's not the best thing for the client, in my opinion. So I'm going to give you a little case study. I have an 85-year-old woman. This is an actual event. It's not the actual person. Her husband died, so she's a widow, leaving responsibility to their broker and a nephew of theirs. The husband had executed a very small option strategy, and you don't need to know anything about options, but it can be risky. But it was just 1% of the portfolio, so a very, very small percent. If the options went away and they lost everything, nothing would have changed about their lifestyle. But the nephew and the broker thought things were a little bit different. So the option strategy went against them, so they doubled down. And they doubled down again, and they doubled down again. Now again, there's nothing wrong with this as long as the risk was disclosed. So as the losses mounted, what did they do? Did they change the option strategy? No. They flew to meet the widow for the very, very first time in their life because they had met with the husband to sign more risk disclosure documents. That's it. Okay? Now, I'm not saying all advisors are like that, but this is legal. And it seems actionable to me, but no lawyer would take this case because she signed the documents. Okay? She lost. She had a $2.5 million account, and in 4 months, $200,000. Actual case. So let me tell you a little bit about our process. We'll actually get back to that. So I'm going to talk a little bit about finance itself. So right here, you have an investment strategy. Let's say this is a bond. Okay? So bonds have a lower amount of risk. So this is risk as measured by standard deviation and a lower amount of return. So if you have two different types of investments, and up here you have a stock. Okay? Stock has higher risk and higher return. Now, if I had a 50-50 portfolio of stocks and bonds, you might assume that the risk and the return would be right in the middle, right? It seems pretty logical, right? Anybody? Yes? Okay, so actually it's not the case, all right? In statistics and in finance, and this is a topic of Nobel Prize winning information that is used prevalently today, if the stocks and bonds are not correlated, meaning they don't act in lockstep, what you get is a bowing of this line. So what happens is for the same amount of return, you can reduce the risk quite a bit if the two assets are not correlated. Or for the same amount of risk, if you're comfortable with that risk, you can improve the return. All right. Now this bowing of the line reduces your risk and improves your potential return, and it's what's called the only free lunch in investing. All right. That's what diversification does for you. Every time I add an asset class that has low amount of diversification or low amount of correlation, it bows that line out. Now most advisors use bonds and stocks, and that's it. 85–90% of all investment portfolios are stocks and bonds, and that's it. Every new asset class I add bows that line out. Now, why don't all advisors bow the line? Because stocks and bonds are what's familiar to their clients. If I add managed futures, commodities, oh my God, the clients are like, that sounds terribly risky. But what it does is it bows the line and makes your portfolio less risky. The problem is, I have to educate them. Most advisors don't want to do that. They don't want to talk to their client and explain this math. It's not that complicated, but they don't want to do it. We take the time to do it. So this is an actual portfolio I had come into my office within the last month. 90% equities, some bonds, some cash, and alternatives. Does this look diversified to you? It's not, okay? About as high level of risk as you can take with no diversification. What we do at Kruse Asset Management is we diversify. So yes, we have stocks, we also go into international. We have bonds, but they're different type of bonds. We have alternatives. These are all low correlated asset classes that can improve your risk profile, improve your returns, and bows the line further out every time. So in summary, advisors invest your money to work more efficiently today. Less risk, more reward. Advisors are fiduciaries of where the client comes first. Diversification is king, and Cam takes this to another level or two, and I haven't actually talked to about some of the details that we do much beyond this, this superficial level. I didn't even mention my QVP that I mentioned my wind sprints, which is double the S&P, so it makes the entire picture that much better. Okay. So what happened to our case study? No, she didn't kill me right now. It's not what happened. I found her a lawyer in my network. Okay? I acted as an expert and testified on her behalf because I have a history of doing that. And she settled for $1 million. Okay? That's what a fiduciary will do for your client. And that's what a broker might not do for you. Questions? I saw Mike first. Correlation. Correlation is when asset classes, how they move together. So if you and I are walking down the street, arm in arm, we're perfectly correlated. If you happen to be zigzagging somewhere and I happen to be going in a different direction, our movements are not correlated. So if you think about a dance troupe and they are all moving together, they're perfectly correlated. If you think of a hip hop artist dancing right next to a ballet person,
so I understand the definition of the word correlated, but I don't know what correlated asset class.
okay, so when stocks go up, bonds don't necessarily go up all the time. They could, but they're not necessarily related. Now, sometimes the relation will take on a positive note, sometimes it'll take on a negative note, but stocks and bonds don't always move up. So to give you an example, you might have been hearing a lot about oil prices in today's market. So oil is super low right now, right? At some point, it used to be that when oil prices dropped, or it is right now, when oil prices drop, that signals that the economy is worse off because people aren't demanding oil and the stock market drops. So when oil drops, stock market drops, that's positive correlation and not good for diversification. That's positive correlation. In other times, oil prices going up has acted as a tax. And then they said, oh, that's bad for the consumers, so stock prices would go down. So they're acting opposite of each other in those cases. Then that's negative correlation. That's actually good for diversification. Okay? So now what we do at Kruse Asset Management is we follow those relationships and how they've changed over time, and we incorporate that into our asset allocation model. So when correlation changes, which it will, we use that as a tool as well.
So my question is, in that pie chart that you were showing, at this time when the world economy is so volatile and chaotic, why did you have such a big chunk in foreign investment?
Oh, that's a good question. So volatility does not necessarily mean bad, okay, actually. Volatility means risk, okay? And when you get some volatility, you get volatility to the upside, volatility to the downside, okay? We're long-term advisors and look at not long-term plans, but we're long-term goal seekers, right? So you want to look at a particular potential in the marketplace. So just because something is doing bad right now in the short term doesn't mean 3, 5, 10 years out it's going to be bad. So if you look at the valuations internationally, and if I'm looking at a 3, 5, or 10-year period, they actually look pretty compelling. Okay?
Even for the older woman?
So the older woman, this wasn't her portfolio, obviously. So the older woman, she could be conservative, in which case we would shrink down her allocation to equities and stocks. But to your point, and this is actually a really important point, and let me see if I can get to that. This part right here, if I were 100% in bonds for the older woman, she said, I am very, very conservative. Some people might think 100% in bonds is the least risky portfolio. But if I add some risky assets, the risk actually gets smaller as her returns go up. So this is the least risky portfolio. So even the most conservative person should have some diversified risky assets in their portfolio. That makes the least risky portfolio. Yeah, Jordan.
What's the distinction between commodities and managed futures?
Okay, so commodities are like an asset like gold is a commodity, oil is a commodity. Managed futures is usually a way to manage those commodities. So managed futures would be, a managed future strategy would be, well, if gold is higher than it was 6 months from now, I'm going to be long gold, or if gold is lower than 6 months from now, I'm going to be short gold, and that's a strategy on how to manage those commodities itself. I can definitely get into more detail with that on it, but the commodities themselves are the underlying asset. Managed futures tends to be how you would manage them or how you would invest them. Okay.
You guys have more questions for Stuart? Definitely grab that first.
Thank you.
I had a one-on-one with Stuart a couple weeks ago. We just